They just show their hand. They just reveal to the entire world exactly how terrified they are. And if you understand what happened during the last week of 2025, if you understand the significance of what the CME just did in the dead of night during the holiday trading session, then you understand that everything we have been saying for years has just been confirmed in black and white. The game is no longer hidden. The desperation is no longer subtle. It is written on the tape for anyone with eyes to see. Ladies and gentlemen, Asian guy here. While you were celebrating New Year's Eve, while you were watching the ball drop and making resolutions, something extraordinary was happening in the commodity pits of Chicago. The CME Group, the institution that controls the futures market, the gatekeeper of paper gold and paper silver, made a move so aggressive, so blatantly manipulative, that it deserves to be studied in history books as the moment the suppression scheme began its final collapse. They hiked the margin requirements for silver futures by $25,000 per contract. Let that sink in. $25,000 in one announcement. During a holiday week when trading volume was at its lowest, when the retail investors were distracted, when they thought nobody was paying attention. They didn't do this because everything is fine. You don't raise margins by 25 grand when the market is functioning normally. You raise margins by 25 grand when you are terrified. You raise margins by 25 grand when your risk models are flashing red. You raise margins by 25 grand when the physical market is about to expose the paper charade for what it truly is. Now you need to understand what a margin hike actually does. In the futures market, margin is the cash deposit you must post to hold a position. It is the skin in the game. When the exchange raises margin requirements, it forces every trader holding a position to immediately come up with more cash. If they cannot post the cash within hours, their position is liquidated. They are forced out of the market. This is a weapon. It has been used for decades to shake out small traders, to trigger cascading liquidations, to push the price in whatever direction the exchange needs it to go. And they deployed this weapon during the thinnest liquidity of the year, when the price of silver was testing resistance at $84. They wanted a crash. They needed a crash. Because at $84, the shorts were bleeding. At $84, the delivery demands were surging. At $84, the structural problems at the COMEX were becoming impossible to hide. So they pulled the emergency lever. And what happened? The price fell. Silver dropped from $84 down to the $70 region. On paper, it looked like the bulls had been defeated. The mainstream financial media ran their predictable headlines. Silver crashes, precious metals collapse. The squeeze is over, they said. Go back to your index funds, they said. But here's what they didn't tell you. Here's what they deliberately obscured. The price found support at exactly $70 and stopped falling. The weak hands were shaken out, yes. The leveraged speculators who couldn't meet the margin call were liquidated, yes. But the physical buyers didn't sell. The industrial consumers didn't walk away. The Chinese didn't blink. And the moment the calendar flipped to 2026, the moment the liquidity returned to the market, the moment real money started flowing again, the price did something that should terrify every bullion bank on Wall Street. It exploded higher. Silver didn't just recover, it didn't just stabilize. It broke back above $80 in the first week of trading, and it is now setting up for the assault on 84 and beyond. The margin hike failed, the manipulation failed, and in failing it revealed exactly how fragile the paper market has become. Think about the desperation required to hike margins by $25,000 during a holiday week. Think about what that decision says about the internal stress at the clearinghouse. They knew that if silver broke above 84 power during that thin liquidity window, the short covering would have been catastrophic. They knew that the vaults are running dry. They knew that the physical delivery demands are at record levels. They had to do something, and the only tool they had left was the margin hike. But here is the fatal flaw in their strategy. A margin hike only works if it scares people away permanently. It only works if the fundamental story changes. And the fundamental story has not changed. It has gotten dramatically worse for the shorts. Let me walk you through exactly what is happening in the physical market right now. Because this is the smoking gun that the CME cannot hide, no matter how many times they raise margins. We are entering 2026 with a physical silver deficit that is the largest in recorded history. The demand from solar panel manufacturers is vertical. The demand from electric vehicle battery producers is vertical. The demand for military applications is vertical. And the supply? The supply is collapsing. Mining output is declining. The ore grades are falling. The easy silver has been extracted. What remains is deeper, more expensive, and harder to get out of the ground. But that is just the supply side. The real bomb that just exploded is on the geopolitical front. China, the world's largest refiner of silver, just imposed export controls starting January 1st, 2026. Read that again. China is now restricting the export of refined silver. They are hoarding it. They are keeping it for their own industrial needs. They are cutting off the West from one of the primary sources of physical metal. Do you understand what this means? The West is already facing a shortage. The COMEX vaults are already at historic lows. And now China, which processes a massive percentage of global silver, has decided that they will keep it for themselves. The supply chain that the Western world depended on has just been severed. This is not a temporary disruption. This is a strategic decision by Beijing to control access to a critical metal that is essential for the energy transition, for military technology, for the entire future of modern electronics. And the CME's response to this existential supply crisis was to hike margins. It is like trying to stop a tsunami with a paper towel. It is laughable if it weren't so tragic. They have no real tools left. They cannot manufacture silver. They cannot force China to export. They cannot make the mines produce faster. All they can do is manipulate the paper price and pray that nobody notices the disconnect between the futures screen and the reality on the ground. But we notice. We always notice. And the chart is confirming everything we have been saying. Let me explain the technical setup because it is beautiful in its clarity. The daily chart for silver shows that the correction from $84 to $70 occurred within the structure of an ascending broadening wedge pattern. This is a powerful bullish formation. It represents intense volatility, yes, but it represents volatility within an uptrend. The lower boundary of this pattern is rising. The higher highs and higher lows are intact. The $70 level was not a breakdown. It was a shakeout designed to trigger stops and liquidate weak hands. And the moment the shakeout was complete, the price reversed violently and began its march back toward resistance. We are now above $80. The next target is $84, the upper boundary of the pattern. And when that level breaks, and I am increasingly confident that it will break, the measured move projects a target of $100, $100 per ounce of silver. This is not a fantasy. This is not hopium. This is the mathematical projection based on the pattern structure. And it is supported by the fundamental reality of a market in severe physical deficit, facing Chinese export controls, facing industrial demand that cannot be substituted, and facing a paper market that has exhausted its ability to suppress. The CME just used its biggest weapon, the margin hike, and it failed. They have nothing left. The margin hike was the last bullet in the chamber, and it missed. Now the price is recovering, and they have to reload, but what are they going to do? Hike margins again? At some point, the margin requirement becomes so absurd that legitimate hedgers leave the market entirely. At some point, they destroy the very exchange they are trying to protect. Now let's talk about gold because the same forces are at play, and the chart is equally bullish. Gold found support exactly where we expected it to, at the 4,280 level, which corresponds to the support of an ascending broadening wedge pattern on the daily chart. The CME hiked margins on gold too, and just like silver, the weak hands were shaken out. The price dropped during that holiday ambush. But also like silver, the price found its footing and reversed. We are now trading back toward the $4,500 resistance level. The 4-hour chart shows something even more exciting. An inverted head and shoulders pattern has formed right at the 4,280 support zone. This is one of the most reliable bullish reversal patterns in technical analysis. The left shoulder, the head, the right shoulder, all clearly defined. The neckline is being tested as we speak. A confirmed breakout above this neckline will trigger a measured move that projects toward the $5,000 level. $5,000 gold. In the old world, before the CME started panicking, before China started hoarding, before the physical shortage became undeniable, that number would have sounded absurd. But we are not living in the old world anymore. We are living in a world where central banks are buying gold at the fastest pace in history. We are living in a world where trust in the dollar is eroding by the day. We are living in a world where the CME has to ambush the market during Christmas week because they cannot control it during normal trading hours. In this world, $5,000 gold is not a ceiling. It is a waypoint on the journey to much higher prices. And speaking of the dollar, let's look at what is happening to the currency that denominates these precious metals. The US dollar index, the DXY, is trapped. It is stuck in a range between 96.50 and 150. The daily chart shows that the index ran into the resistance of the 200-day simple moving average and failed. It could not break through. The bulls tried to push the dollar higher, and they were rejected. Now the index is consolidating in a tight range, coiling like a spring. But look at the structure. The 200-day moving average is acting as a ceiling. The momentum is fading. The 4-hour chart shows that while the dollar is bouncing from the 97.50 support, it is struggling to get above 99. As long as the 100.50 level holds, the overall picture for the dollar remains bearish. And if the dollar breaks down through 96.50, we are looking at a cascade toward the 94 and 92 levels. A weaker dollar is jet fuel for precious metals. Gold and silver are priced in dollars. When the dollar loses value, the nominal price of metals rises automatically, just to stay constant in real terms. But we are not just seeing a stable real price. We are seeing rising real demand for physical metal combined with a falling dollar. This is the double engine that propels precious metals into parabolic moves. The CME tried to break this momentum. They failed. The margin hike was supposed to be the knockout punch. Instead, it was a glancing blow that only made the bulls angrier. Do not let anyone gaslight you into thinking this was normal market behavior. There is nothing normal about hiking margins by $25,000 during a holiday week when nobody is trading. There is nothing normal about deliberately attacking a market during its most vulnerable moment. This was a coordinated attempt to break the back of the silver rally before it could reach escape velocity. And it didn't work. The price is now higher than it was before the attack. The physical demand is stronger than it was before the attack. The structural problems at the COMEX are more exposed than they were before the attack. This brings me to the most important part of today's report, the strategic implications for you as an investor. The margin hike backfiring is a signal. It tells you that the exchange has lost control. It tells you that the physical market is now driving the paper market, not the other way around. For 40 years, the paper market set the price. The futures screen dictated what physical metal cost. But that relationship is breaking. The premiums for physical coins and bars are expanding. The delivery demands at the COMEX are surging. The Chinese export controls are cutting off supply. The paper price is increasingly becoming a fiction, a number on a screen that bears less and less relationship to the actual cost of obtaining real metal. This is the disconnect we have been warning about. This is the moment when the paper price and the physical price begin to diverge permanently. If you own paper claims on silver, whether through ETFs or futures, you need to understand that those claims may not be honored at the screen price when the crunch comes. The only way to guarantee that you capture the full value of this move is to hold physical metal in your possession. Not a paper claim, not a promise, the actual atoms. The CME can hike margins all they want. They can raise them to $100,000 per contract if they wish. It will not change the fact that there are more paper claims than there is metal to back them. It will not change the fact that China is hoarding. It will not change the fact that industry needs silver and there is not enough to go around. All the margin hikes do is prove that the system is under stress. So what happens next? The technicals are clear. Silver needs to break above $84 to confirm the next leg of the advance. Once $84 falls, $100 becomes the target. Gold needs to break above $4,500 to confirm the inverted head and shoulders pattern. Once $4,500 falls, $5,000 becomes the target. The dollar needs to break below 96.50 to confirm the bearish structure. Once that happens, the tailwind for precious metals becomes a hurricane. All of these levels are within striking distance. All of these breakouts could happen in the coming weeks. The fundamentals support them, the technicals support them, and the behavior of the exchange, the desperate margin hike during a holiday week, confirms that the institutions know what is coming. They are scared. They showed you their fear in the most transparent way possible. They used their ultimate weapon, and it bounced off the shield of physical demand. The stackers did not sell. The industrial buyers did not walk away. The Chinese continued their accumulation. The $25,000 margin hike was absorbed, digested, and overcome. This is resilience. This is structural demand. This is the kind of buying pressure that breaks suppression schemes. We are witnessing the end of an era. The era of unlimited paper manipulation is drawing to a close. The era of physical scarcity is beginning. And those who position themselves correctly, those who hold the metal, those who understand that the paper price is a lagging indicator of the true value, they will be the beneficiaries of the greatest wealth transfer in a generation. The CME fired its shot, the price dipped, the price recovered. The target remains $100 silver and $5,000 gold. The dollar remains under pressure. China is hoarding. Industry is desperate. The vaults are draining. The pattern is holding. And the exchange is running out of tricks. I am Asian guy. The metals are moving. Do not let them shake you out. See you on the other side.